Bitcoin and other cryptocurrencies have been around for years, but they're still a relatively new asset class. They've had some attention-grabbing headlines, and they've seen interest grow. But do they belong in your portfolio? Should you be actively trading them or buying and holding? That's not exactly an easy question to answer. And unlike more traditional assets, there aren't a ton of fundamentals to consider. No products made, no services rendered. So let's break down some of the choices investors have when it comes to cryptocurrencies, including how different investors and traders might want to allocate crypto in their portfolio. Briefly, cryptocurrencies are a form of digital currency that can be used for electronic payments or as a store of value. Bitcoin is the biggest, and it's typically the baseline when talking about crypto. It established blockchain technology, which is a type of ledger most cryptocurrencies use to track transactions. There are different blockchains with their own native currencies, like the Ethereum network and Ether. More cryptocurrencies pop up all the time, but these are the two we'll focus on. Like other financial assets, think stocks or bonds, cryptocurrencies can be traded and the price rises and falls with changes to supply and demand. But crypto assets aren't physical currencies. They're not backed by major central banks, and most don't provide any cash flow or dividends. But that hasn't stopped society from deeming it a valuable asset class. On one hand, crypto bulls say cryptocurrencies could become more widely integrated into the global financial system. The bulls attribute this to the flexibility and transparency of cryptocurrencies as digital stores of value. But on the other hand, crypto bears say they've faced slow adoption due to a lack of government regulations and the potential of being hacked. If you're a speculative trader, you could profit or lose either way. But if you're interested in long-term crypto investing, how much crypto should you hold in your own portfolio? Well, it all comes down to your risk tolerance. Cryptocurrencies like Bitcoin and Ether are notoriously volatile. But if you take a longer-term look, they've experienced a meteoric rise since Bitcoin's inception in 2009. There are so many coins that it's hard to look at the historical performance of crypto overall, so we'll use Bitcoin since it's the largest and most established. Take a deeper look at this Bitcoin price chart. You can see some major downturns in the value over time, including several drawdowns of more than 50%. It's a similar story for many other cryptocurrencies too. This volatility may be too much for some investors to handle. The trade-off is that Bitcoin has historically exhibited very low correlation on a long-term basis to other asset classes. But if we simplify the chart a little bit and just look at the annual low of Bitcoin, you'll see the lows have grown consistently since its inception. This perspective may be helpful for investors who are concerned about the volatility. Another risk that's worth noting is encryption risk or cybersecurity risk. Exchanges can be hacked, passwords and private keys can be lost or stolen, and transactions are irreversible. Plus, cryptocurrencies are not stored in traditional banks and lack the federal protections of other investments. A longer-term concern is that one day, quantum computing could get through the encryption protecting Bitcoin's blockchain. That could make billions of dollars of Bitcoin vulnerable to theft. On the other end of the risk spectrum is the opportunity risk, or the risk that by not investing, you may miss out on another potential meteoric rise. It's a large, global, liquid asset class. And from that perspective, it's not all too different from equities. As of October 2025, Bitcoin had a similar market cap to that of Amazon. Some investors see digital assets as a new type of hedging strategy against market downturns. For example, from 2015 to 2025, the price of Bitcoin appeared to have essentially no correlation with major equity or bond indexes. Having investments that don't rise and fall at the same time can help manage losses, and Bitcoin has historically shown very low correlation to other asset classes on a long-term basis. Still, it's not quite in the same category of more traditional hedges, like precious metals or treasuries, but a small position may be an efficient way to add diversification to your portfolio. You'll just have to determine if you can stomach the volatility and the risk. If you decide to invest in cryptocurrencies, you'll need to determine how much. Making an allocation based on risk tolerance instead of by dollar amount or portfolio percentage could make more sense with cryptocurrencies. Because they're so volatile, even small amounts could translate to much larger levels of risk. Let's look at a quick hypothetical example using Bitcoin. A theoretical investor with a moderate risk appetite might split a traditional portfolio 60-40, 60% stocks and 40% bonds. Stocks consist of almost 100% of the risk in that portfolio because they're far more volatile. If that investor decides to add an even more unruly asset like Bitcoin, they might only want Bitcoin to make up 10% of the portfolio's risk. According to the Schwab Center for Financial Research, that investor might want to invest no more than 2.7% of their total portfolio in Bitcoin. An aggressive investor, say they typically put 96% of their portfolio in stocks, might be comfortable with 20% of the portfolio's risk in Bitcoin. That would translate to an allocation of just under 7%. Other cryptocurrencies like Ether are more volatile than Bitcoin, so you may want to consider investing even less. It's a bit non-traditional to think about it from a risk perspective rather than an overall portfolio percent perspective. Bitcoin's volatility means it has an outsized risk. It's an exponential relationship, so small increases in Bitcoin holdings can lead to larger increases in overall risk exposure. Cryptocurrencies can be complicated and confusing for beginners. Start by learning the basics, understanding the risks and your own risk tolerance. Remember, if buying cryptocurrencies themselves is too big of a jump at first, you could consider starting with exchange-traded products that include cryptocurrencies, although those have their own risks as well. Never invest more than you can afford to lose, whether you're looking to trade crypto actively or take it on as a long-term investment. Coming from a risk management perspective can be helpful. Patience, discipline, and consistent learning can help you introduce crypto into your portfolio.